Viraj Patel, Vanda Research Global Macro Strategist. Viraj, very nice to speak to you. How high or low are your expectations for Jackson Hole? Because it is a quiet week otherwise in terms of the economic agenda. Plenty of geopolitics going on, of course, as we all know. But in terms of the economic agenda, fairly quiet. And we've talked a lot about Jackson Hole. And the closer we get to it, the more people seem to be sort of downplaying their expectations. So what are you expecting to hear?
Yeah, our expectations are fairly low. I think, Jackson Hole will probably be a non-event broadly, with Powell sending enough sound bites for both the Doves and the Hawks to cling on to. So I think, there'll be enough to read between the lines, and you probably won't see much of a market reaction, even though there's some sort of volatility priced in. I think the real story is really, actually a neutral Powell could arguably be, a win for the Hawks to some extent. Especially if the Fed chair doesn't use this speech to walk back the broad expectations that there will be some Fed policy taper announcement at some point this year. So, look, as long as we get a neutral Powell, I think, as I mentioned, there'll be enough for both the Doves and the Hawks to cling on to. And I think all eyes really onto next week's payrolls print, and then onto the September FOMC, which will probably be a much more relevant market event.
Good morning, Viraj. So you think that no taper news gives us a little bit of a hawkish reaction? I have some kind of sympathy with that idea. But yet, your views is that the 10-year yields will only reach, 1.5% or so. I think it's a minimum of 1.5% by the time tapering might kick off in November, December. So that's, 15, 20 basis points in 3 months. A very, very small move you're looking for in yields. And yet I understand you think it's going to be more negative for cyclical equities this time. Can you explain that thinking?
Yeah, I think, a couple of reasons really from the level for the 10-year, at least 1.5. When we look at sort of some of the past tightening cycles and lift-off dates, realistically, the 10-year has traded pretty much in line with the expected terminal rate at that point in time. Now, obviously, the terminal rate is much lower than it is today versus maybe back in 2013. And the second reason, really, we're probably not going to get much of a tantrum this time around, but just a normalization. Less of a tantrum, more of a normalization is probably our message. And if you think about things, the 2013 tantrum was a one-off event. A lot of uncertainty on what that actually looks like. We're now well telegraphed on what this Fed will deliver in terms of pace of reductions to some extent, the speed, the fact that the balance sheet won't necessarily, reduce in absolute terms for a long time. So all of those factors limit the extent to which the back end can move higher. But I think the key difference today versus 2013 is that the Fed will probably be tightening into a slowdown in growth, not necessarily a capitulation in growth, but a slowdown in growth. And I think that's a key difference in terms of how the equity market reacts. Certainly cyclical equities, which, unlike the first half of this year where they sort of rose in line with higher treasury yields, there will be very few places to hide this time around when rates move higher and we're in a sort of slowdown environment when it comes to the global growth backdrop.
In terms of that message on cyclical equities and in terms of where the yields go from here, Viraj, I guess you're focused on what Powell has to say about the Delta variant, but also how the Delta variant then develops into the winter in the United States and here in Europe. What risks do you think, to your views, are attached to that?
Yeah, I think our first sort of channel and thoughts really when it comes to the Delta variant is what are the knock-on effects for policy, and obviously not just policy from a central bank perspective, but also government policy around lockdowns and restrictions. Now, obviously, this year vaccines do help relative to last year, so that should mitigate some of the risks for severe lockdowns. But and nothing can be ruled out to some extent. And I think that's really a lot of that worry has been priced into the bond markets quite well. And we've seen that over summer. We've seen that also in positioning with a huge flush out in treasury positioning over short treasury position over summer. So, I think that from a policymaker perspective, what we should expect if we were to get any tightening messages from any central bank really in the next 2 to 3 months, it will be caveated with a very cautious message. And I think, as I said, rather than seeing tantrums in the bond market that we were used to, maybe in 2013, maybe we saw earlier this year, it's probably going to be more of a gentle normalization this time around.
Viraj, thanks very much. Stay with us. Viraj Patel, Vanda Research Global Macro Strategist, with us this